Hey, good morning, everybody. Today is Monday, February 2nd, 2015. Happy Groundhog Day. My name is Cliff Backus. I'm the Chief Market Strategist for Push Button Stock Trading, and this is your daily video market review. Last week, stocks struggled with 3 powerful down days and 2 weak up days. The S&P 500 fell 2.8%. The NASDAQ 2.6 for the week. Let's take a quick look at the NASDAQ. On Friday, we lost 48.17 points, or 1.03%. NASDAQ closed at the bottom of its daily trading range, and trading volume was higher. That's the definition of a distribution day, a lower close with higher trade. That was the third distribution day for the NASDAQ since confirmation of the rally on January 8th. It's not enough to send the NASDAQ into a market in correction, but it is enough to raise a little bit of concern. Right now, we are on a market in transition signal on our 1 to 6 month timing model. The NASDAQ is bracketed by minor support in the 45.67 area and resistance in the 48.11 range. Taking a quick look at the MACD histogram. Friday, the MACD closed below the 0 line, which is bearish, and is trending downward, which is also bearish, because we have 2 bearish signals on the MACD histogram. Our immediate outlook on the NASDAQ is currently bearish. Let's take a quick look at the S&P 500. We can get down in the weeds a little bit on the S&P 500. Let's start by taking a look at how we fared on Friday. On Friday, we were down 26.26 points, or 1.3%. Trading volume was higher than the prior day, giving us another distribution day. We currently have 5 distribution days on the S&P 500 since the market confirmed the uptrend on January 8th. The designations on the market of confirmed uptrend, uptrend under pressure, and market in correction come directly from William O'Neill's book, How to Make Money in Stocks. I was raised on William O'Neill and have a real hard time getting rid of my O'Neillian view of the markets. So I want to explain something real quick here. According to O'Neill, in order for a market to go into correction, we need to have at least 5 distribution days. We have 5 distribution days. 1, 2, 3, 4, 5. The market has to be trading at least 3.5% below its recent high. We are well below 3.5% below our recent high. And the market has to be trading at least 0.2% below its 21-day exponential moving average. And we've certainly done that as well. Technically, this market should be in correction. But you see where the market closed in relation to minor support. We closed right on this minor support level right here. And because of that, I'm not going to make the call market in correction just yet. We're going to give this market another day to see if we hold this minor support area and move back higher. If on Monday, if today we close below the minor support in the 1992 area. We'll go to a market in correction. But until that time, we're going to hold on to a market under pressure for right now. Okay, having discussed that, now let's talk about our 1 to 6 month timing model. Our 1 to 6 month timing model is showing a market in transition still. In order for our 1 to 6 month timing model to go to a market in correction, we need to see three things. First, we need to see the 10-day simple moving average lower than the day before. Second, the 21-day exponential moving average needs to be lower than it was 2 days prior. And finally, the market has to close at least 1% below its 21-day exponential moving average. Right now, the market is more than 1% below its exponential moving average. The 21-day exponential moving average is trading below where it was 2 days ago. The only thing keeping this market from going to a don't buy signal is the fact that our 10-day moving average is still higher than it was the prior day. On Monday, today, if the market doesn't capture this lower envelope, which is 1% below the 21-day exponential moving average, I would expect that we go into a don't buy signal on the market. So I recommend caution on the markets at this point, particularly on the bullish side, but on the bearish side as well. We are right at support on the S&P 500. Our 1 to 6 month timing model is right at a turning point, and our O'Neill model is also right at a turning point. So the market's in flux right now. We are in a sideways trend on the short term. We continue in an uptrend on the long term. We continue in an uptrend on the intermediate term. We'll see what the market does this week. Finally, let's take a quick look at the MACD histogram on the S&P 500. MACD histogram on Friday closed below the zero line, which is bearish. It's also trending down, which is bearish. Our immediate bias on the S&P 500 is bearish right now. If you want to talk about the markets or any of our trading strategies, please feel free to give me a call. Drop me an email, or if you'd prefer, make an appointment. Come by the office, see what we're up to. If you're out of the area, we can also set up a Skype session. See my contact information on the home page. If you've not already done so, please take a minute to subscribe to Push Button Stock Trading. Finally, please take a quick look at our disclaimer video, which is posted below this one. Again, my name is Cliff Backus. That's your daily market review. Have a safe and profitable day. Keep your stops in place. Hopefully the groundhog won't see its shadow. And we will see you again tomorrow.